You're navigating the world of investing, looking for growth, for returns, but you're also a conscious capitalist. You care deeply about the impact of your money, where it comes from, where it goes, and what it does in the world.
Mhm.
You want your portfolio to reflect your values, maybe even drive positive change. Seems straightforward, right?
Yeah, if only it were that simple.
Hmm.
This intersection of finance and values has become, well, one of the most complex and, frankly, contentious areas in the market today.
Right.
It's far more than just aligning your investments with your personal ethics. It's a landscape filled with acronyms, evolving definitions, and some really intense political debate. Terms like ESG, ethical investing, sustainable investing, impact investing, they're just everywhere, often used interchangeably, which, creates a lot of confusion.
Totally.
For someone like you trying to cut through the noise and genuinely understand what's going on, especially here in the US, it can feel incredibly challenging.
It absolutely does. It feels like you need a roadmap, maybe even like a translator, just to figure out what these different approaches actually mean and how to implement them effectively.
Exactly.
So today, we are embarking on a deep dive specifically tailored for you. We're going to take a close look at your sources, a sharp policy paper offering a free enterprise perspective on ESG, and the latest comprehensive report from USIF on U.S. sustainable investing trends.
And our mission today is really to unpack this tangled world. We'll trace the roots of investing with values, clarify the often confused terminology, explore the specific strategies investors are actually using today.
Yeah, what are people really doing?
Confront the significant challenges and controversies that are, let's face it, dominated the conversation. And look at where this field might be headed. We want to give you the clarity you need to understand these nuances and make informed decisions aligned with both your financial goals and, importantly, your principles.
Okay, sounds good. Let's start at the beginning then. This whole idea of investing with values, it feels very modern with all the talk about ESG and reporting, but your sources suggest this isn't really a new concept at all. Where did it actually begin?
You're right, it's not new. The roots go back surprisingly far. The notion of aligning financial decisions with ethical or moral considerations isn't unique to our time, not at all. In fact, values-based investing has historical ties stretching back millennia, often embedded in religious or moral codes. But the practice really started taking a more, let's say, formal shape centuries ago, particularly championed by religious institutions. They were among the first large asset holders to really grapple with the ethical implications of their investments.
So it wasn't just about making money, it was about whether the source of the money or the activities it supported were considered, well, acceptable.
Exactly. Your sources highlight some tangible early examples right here in the United States. In the late 19th and early 20th centuries, denominations like the Methodists and Quakers took clear stances. They started divesting from activities they deemed harmful, such as the slave trade and other illegal enterprises.
Okay.
And they also actively avoided investments in what became known as sin stocks, companies involved in alcohol, tobacco, gambling, that kind of thing.
Right, the classic sin stocks.
Exactly. And it's interesting, even America's second oldest mutual fund, the Pioneer Fund, for a significant period, maintained a policy of avoiding these specific industries based on these ethical considerations.
That really grounds it in history. It wasn't just abstract. It was about making deliberate choices to say, okay, our capital will not support that.
Precisely. And this practice gained significant momentum and broadened its scope dramatically from the 1960s through the 1980s. This was a period of intense social change in the U.S., right? Fueled by movements like the Civil Rights struggle, opposition to the Vietnam War, rising awareness of environmental issues, concerns about labor standards, and of course, the global anti-apartheid movement.
Huge changes, yeah.
As these movements grew, so did calls for investors to align their portfolios with these social and political causes. Divestment from companies involved in apartheid South Africa, for example, became a really prominent tactic used by universities, pension funds, other institutions.
So it evolved from individual or group moral stances to a more public and activist approach, using investment decisions as a tool for broader social change.
Absolutely. It became a way to exert financial pressure and publicly declare solidarity with specific social or environmental goals. And this historical evolution helps us understand one of the core definitions presented in the C3 Solutions paper we looked at, which uses this concept of values-based ESG.
Okay, values-based ESG.
This approach, as defined by Professors Eccles and Fish in that paper, is about investing according to a set of principles, irrespective of any link between those principles and economic value.
Ah, that distinction is key. Irrespective of any link between those principles and economic value. So it's driven purely by principle, not necessarily by an analysis of how those principles might affect financial returns.
That's the precise distinction the paper makes. They view this type of values-based approach as analogous to the historical socially responsible investing, or SRI, or even older definitions of impact investing. The motivation is primarily alignment with deeply held values or principles, regardless of whether that alignment is expected to enhance or maybe even detract from financial performance.
Right.
The paper gives examples of principles driving this, things like supporting gender diversity or animal rights. And notably, it mentions the Maggie Index neutrally as another example.
Oh, interesting.
Yeah, illustrating how politically driven support can also fall under this umbrella of values-based investing, where the value is political alignment rather than maybe more traditional social or environmental concerns.
That Maggie Index example is quite illuminating. It demonstrates that values in this context can span a really wide spectrum and aren't limited to what might be considered traditional progressive causes. It's about using investment to support any set of principles, really.
Exactly. It highlights that the concept of values-based investing at its core is about applying personal or institutional principles to investment decisions. And those principles can come from very different places, politically or otherwise.
Right.
Now, this brings us to how the broader terminology has evolved, particularly as documented in the USF report.
Okay.
USSF, which used to be known as the Social Investment Forum and is now just USF, has been chronicling the growth of this market since way back in 1984 through its biennial trends report. That's the other key source for us today.
Right, the trends report.
Their research shows a significant evolution. It started as, they say, a niche approach focusing on values-driven decision-making in its infancy, but it's become a much broader field now, one that's centered on financial risks and opportunities directly impacting corporate enterprise value.
Okay, so it started with values, but the field has increasingly focused on how these factors connect to the bottom line, to the actual financial performance.
Precisely. The market matured, the analysis got more sophisticated, recognizing that factors related to environmental impact, social issues, governance practices, the E, S, and G, can actually have material financial consequences for companies. And within this evolution, impact investing has emerged as a more clearly defined approach. While that historical values-based investing might focus on avoiding harm based on principles, negative screening.
Yeah, don't invest in the bad stuff.
Right. Modern impact investing is specifically about making a positive social or environmental impact alongside financial returns.
So impact investing is more proactive then, aiming to create something positive rather than just avoiding something negative.
Yes, that's the key distinction. Impact investing often involves actively seeking out investments in companies, organizations, or funds with the explicit intention of generating measurable, positive social or environmental impact. And this is important, measuring those out.
Measuring, okay.
The USF report highlights that making a positive social or environmental impact was cited as a driver by 72% of their survey respondents. That's a big number. Meanwhile, sustainable investing or responsible investing serves as a broader umbrella term encompassing various approaches.
Okay, so that's the big tent.
Exactly. This can include the historical values-based or ethical approach, but it also includes ESG integration, which, as we discussed, focuses on how E, S, and G factors can materially impact a company's financial performance and risk.
Right, the financial materiality piece.
As well as thematic investing and impact investing itself.
Got it. So maybe to recap, ethical or values-based investing often starts with exclusion based on principles. Impact investing is about generating measurable positive outcomes. ESG integration is about analyzing E, S, and G factors for financial materiality, for risk and return. And sustainable or responsible investing is the big picture term covering all of these strategies.
That provides a much clearer framework, I think, for understanding the different approaches you see buzzing around in the market today. It's really a spectrum with different motivations and different primary goals driving each one.
Okay, that really helps to clarify the language, which can be so confusing sometimes. Now that we have a better handle on the different concepts, what are investors actually doing with their money in this space? What strategies are most prevalent according to your sources?
Well, one of the most fundamental and historically significant strategies, building directly on those early examples we discussed, is negative screening, or just excluding certain investments from a portfolio.
So this is literally saying, I won't invest in X, Y, or Z.
Exactly. It's defined as excluding specific sectors, companies, countries, or issuers based on activities that are deemed not investable due to established norms or personal or institutional values. Your USF source confirms this remains a widely used strategy today. 67% of their surveyed respondents employ it.
2/3. Okay.
Yeah, and often investors use multiple exclusion criteria simultaneously. It's not usually just one thing.
What are the most common things getting screened out in today's market then?
Based on that USF report, the most frequent exclusions are tobacco, 66% of respondents apply this screen. Then fossil fuels covering coal, oil, and gas, that's actually the highest at 68%.
Oh, wow. Higher than tobacco?
Yeah, slightly. Then military and weapons at 63%, gambling at 55%, alcohol at 49%, and pornography also at 49%. They also list nuclear energy, 37%, and animal testing, 28%, as other significant exclusion areas.
It's interesting that fossil fuels slightly edge out tobacco now. That does seem to reflect the current climate focus.
It certainly does. It reflects the increasing global focus on climate change and energy transition issues, which we'll definitely touch on more. The report also identifies emerging areas that investors are increasingly excluding. And this list is quite comprehensive. It really shows the expanding scope of values-based concerns.
Like what?
Things like companies breaching the UN Global Compact principles, private prisons for profit hospitals, certain factory farming practices, extractive agriculture, major producers of synthetic pesticides.
Okay, quite specific.
Very specific. Also, companies providing services or distribution for fossil fuels, utilities planning new coal plants, controversial technologies like genetic engineering and facial recognition, companies with significant issues related to social media impact or data privacy, and sectors linked to deforestation, think palm oil, soy, timber, cattle ranching.
That's a really detailed list. It shows how nuanced these exclusions can get and how they're adapting to current social and environmental debates. This strategy really feels like the most direct form of ethical investing, actively avoiding companies whose core business conflicts with your principles.
It is. It's a clear manifestation of that values-based investing idea. Now, moving beyond just exclusion, another major strategy is ESG integration.
Right.
Unlike pure negative screening, this approach explicitly incorporates environmental, social, and governance factors into the traditional investment analysis and decision-making process, but with the specific goal of enhancing risk-adjusted financial returns.
So here, the ES&G factors aren't just moral checkboxes. They are viewed as financially relevant data points, potentially impacting the bottom line.
Precisely. The focus is on materiality, how these non-financial factors could impact a company's long-term financial health, its operational risks, its competitive advantage, and ultimately, its stock performance or creditworthiness. The USF survey highlights the factors most frequently considered in this analysis. Unsurprisingly, climate change is top, used by 80% of those doing integration, followed by labor standards, 72%, human rights, 66%, board structure and composition, 74%, and transparency and disclosure, 73%.
So investors using this approach are analyzing these issues because they believe they can provide insights into a company's potential risks and opportunities that traditional financial statements alone might miss.
Exactly. This is a key part of that evolution. The USIF documents the shift towards recognizing the financial impact, the financial relevance of ESG issues.
Okay, so if negative screening is about avoiding the bad, based purely on principle, ESG integration is about analyzing all factors, including ESG, to try and pick the best financial performers or avoid the worst risks from a financial perspective.
That's a good way to put it. It's incorporating a broader set of data points into a financially driven analysis.
Yeah.
Then you've got thematic investing.
Thematic, okay.
This strategy involves selecting assets specifically to gain exposure to specified sustainability-related trends or themes.
Like investing directly in the growth of renewable energy or sustainable agriculture, that kind of thing.
Exactly. It's about identifying large-scale environmental or social challenges like climate change or water scarcity, and then investing in the companies or technologies that are providing solutions to those challenges.
Okay.
The USEIF report notes continued growth in this area, and this often overlaps with impact investing because the themes themselves are frequently tied to achieving positive environmental or social outcomes. Investing in clean energy, for example, is a thematic strategy, but it also directly contributes to mitigating climate change, which is a major area of desired impact.
Right, so thematic investing is focusing capital on the solutions part of the equation. What about using your influence as an owner? as a shareholder.
Yes. That falls under the umbrella of stewardship and shareholder advocacy. And this is actually the most common practice reported by U.S. SIF respondents. A significant 76% engage in some form of shareholder engagement.
76%. That's high. What does that look like in practice?
Well, it involves leveraging the rights and influence you have as an investor. This can be through direct engagement with company management, having conversations. It involves casting proxy votes at annual meetings. It can mean filing or supporting shareholder resolutions on specific ESG issues. And it often involves participating in investor coalitions to amplify influence.
Okay.
The goal really is to protect and enhance long-term value. And this includes considering value tied to common economic, social, and environmental assets that might be affected by the company's operations.
The report had specific figures for these activities, right?
It did. Shareholder engagement itself was 76%. Proxy voting was used by 68%. Joining investor coalitions, 60%. Engaging in public policy advocacy, 52%. And actually filing shareholder resolutions was 49%. And they noted a strong core group, over 60% of respondents, actively undertakes 3 or more of these different stewardship actions.
So it's not just buying stock and sitting back. It's actively trying to influence corporate behavior from within. What's the ultimate aim of this stewardship? Is it just about making noise?
No, the goal, as described in the report, is really to affect change. It's about using the tools available to shareholders to shine a public light on potential risks, whether they're environmental, social, or governance related, and to push companies to address those concerns, improve their practices, and increase reporting on their ESG performance.
Okay.
The source notes that successful stewardship is seen as contributing to risk reduction and ultimately long-term value creation for the company and its shareholders.
I saw in the report that the recent 2024 proxy season had some interesting trends in terms of what issues shareholders were focusing on in those resolutions.
Yes, it did. The key focus areas for shareholder resolutions included, unsurprisingly, environment and climate change.
Yeah.
Also corporate political influence, things like lobbying disclosures and political spending. Human rights remained a key topic. Diversity and equitable treatment, concerns around animal agriculture practices, and increasingly we're seeing resolutions related to artificial intelligence governance.
AI governance, interesting.
Yeah, that's a newer one. And while the report noted that the overall volume of explicitly pro-ESG shareholder proposals actually declined slightly compared to previous peak years.
Oh, it went down.
Slightly, yeah. But the report highlights that certain topics, like climate change and corporate political spending, continue to receive significant levels of shareholder support. And issues based on established norms, like indigenous rights, also saw strong backing.
That suggests that while the political rhetoric around ESG might be shifting, certain fundamental issues remain important to a significant chunk of investors.
I think that's fair to say.
And you mentioned something earlier, this idea of pass-through voting or split proxy voting. This seems like a direct response to some of the complexities or criticisms in this space, doesn't it?
It is a very interesting development, yeah, and the report touches on it. It's basically where large asset managers think firms like Vanguard, BlackRock, State Street, the big players, are beginning to offer their clients the option to vote the shares held in their funds according to the client's own specific beliefs or policies.
Wait, so if I have my retirement money in a large mutual fund, the fund manager might offer me a way to direct how my portion of the shares vote on things like climate resolutions or diversity proposals.
That's the general idea, yes. Though the options currently vary significantly by firm and by client type, it's often more readily available to large institutional clients like pension funds right now. But it's starting to trickle down in some forms.
Why is this happening now?
Well, the impetus for this change comes partly in response to the criticism directed at these large asset managers for their own proxy voting practices. They've been accused by some of being too woke and pushing ESG too hard, and by others of not being aggressive enough on ESG issues.
Caught in the middle.
Exactly. It's also driven by strong demand from the asset owners themselves, large pension funds, endowments, sovereign wealth funds who want greater control. They want to ensure the shares they ultimately own are voted in a way that aligns with their specific fiduciary duty or their specific values, rather than potentially having their manager vote against a resolution they would have supported or vice versa.
So it's a way to customize and maybe deflect some of that political heat.
It seems to serve both purposes, yeah. It's a fascinating mechanism evolving to address the diversity of opinions and the intense political pressure in the market right now. But ultimately, stewardship, whether through engagement or voting, can be driven by both ethical motivations, advocating for principle-based changes, and impact motivations, pushing for measurable improvements in outcomes.
Okay, so we've got screening, integration, thematic investing, and active stewardship. That covers a lot of ground. Is there another major strategy we should talk about?
Yes, and it's one that represents a very direct form of impact: community investing.
Community investing. Okay.
While the other strategies often focus on publicly traded companies, community investing typically involves directing capital to individuals and communities that are underserved by conventional financial services.
What kind of investments are we talking about here, like specifically?
This can include investing in things like community development loan funds, local credit unions, or other specialized institutions. These organizations provide responsible lending for small businesses. They finance affordable housing projects. They support community facilities like healthcare centers or schools, and they offer essential financial services to low-income individuals or in underserved areas.
Okay.
These institutions, often certified as Community Development Financial Institutions, or CDFIs, play a crucial role. They provide access to capital and financial services in places where traditional banks may not operate, helping to avoid predatory lending practices and really foster local economic growth.
That sounds like a very tangible, ground-level way to have a positive impact with your money. Very direct.
It absolutely is. It's a clear example of impact investing, where the capital is intentionally directed towards specific social outcomes and helping specific communities. And the growth in this area has been just remarkable.
How remarkable.
Your USI source notes that assets managed by community investing institutions saw a massive surge. They increased from about $64.3 billion back in 2014 to a staggering $458 billion by 2022.
Whoa. $64 billion to $458 billion in 8 years.
That's right, a 650% increase. Just incredible growth.
What's fueling that kind of expansion? That's huge.
Several factors, according to the report. It's partly due to the expansion of the institutions themselves. More banks, credit unions, and loan funds are seeking and receiving that CDFI certification.
Okay.
It's also because these institutions are diversifying the types of assets they invest in. They're moving into areas like microfinance, sustainable agriculture, affordable housing development, even community-scale renewable energy projects. But crucially, a significant driver is the increasing demand from investors, both institutional and individual, for more direct and tangible forms of sustainable and impact investing. They want investments that align with specific social equity and human rights goals.
Makes sense.
The report mentions that nearly half of the specific impact themes identified by investors in the U.S. CHI survey align directly with the core focus areas of these CDFIs.
So despite all the debate and controversy around ESG in the public markets, this sort of quieter corner of community investing is seeing explosive growth driven by very clear impact goals.
It really highlights that capital is indeed flowing towards addressing specific social needs, maybe sometimes outside of the highly politicized public market arena.
Okay, so we've explored the history, clarified the terms, detailed the main strategies investors are using, everything from exclusions to community development. But, it's impossible to discuss this topic right now without addressing the storm of challenges and controversy swirling around it. Your sources make it crystal clear this is a difficult, contentious space.
They certainly do. The C3 Solutions paper, in particular, doesn't pull any punches. It states that the ESG movement has become a contentious battleground ranging from woke finance to corporate greenwashing, and it has become a proxy battle in the larger culture war and against capitalism. That language really emphasizes the intense conflict surrounding this issue.
Yeah, proxy battle in the culture war, that captures the political heat perfectly. What are the primary concerns being raised from a perspective critical of certain ESG approaches, like the one outlined in that C3 paper?
A major concern, particularly when government or regulatory actions start touching on ESG, is the potential negative impact on American investment and retirement accounts. We're talking about immense sums of money here. Public pension assets alone were close to $5.2 trillion at the end of 2022.
Wow.
And many state laws, plus traditional interpretations of fiduciary duty, mandate that decisions regarding these assets must be made solely to maximize financial returns for the retirees. That's the core duty.
So the worry is that if ESG considerations, especially those maybe not clearly linked to financial materiality, are mandated or prioritized by government action, they could potentially conflict with that core fiduciary duty to the retirees whose money is being managed. Is that the fear?
Exactly. The paper points to the Department of Labor's regulation, for example, which allows ESG consideration in a tiebreaker situation when evaluating investments. The concern raised is that this could potentially be interpreted or applied in a way that biases the investment process towards non-pecuniary factors, risking suboptimal financial outcomes. The concern is articulated quite strongly as a fear of gambling with other people's money by potentially prioritizing political or social goals over purely financial returns.
Okay. Beyond the political and fiduciary concerns, though, there also seems to be a fundamental issue with just defining and measuring ESG itself.
Absolutely, and both sources touch on this significantly. The C3 paper highlights the problem of ESG's ill-defined definition and subjectivity as to what does and does not fit under the umbrella of E, S, or G. What counts as a positive or negative environmental factor, for instance? The example given is exporting liquefied natural gas, LNG. Is that good because it's cleaner than the coal it might replace in some markets? Or is it bad because it's still a fossil fuel contributing to greenhouse gas emissions? These are complex trade-offs with really subjective answers, not clear-cut objective metrics.
And that subjectivity makes measuring ESG performance or actual outcomes really difficult, doesn't it?
It does. And this lack of transparent objective metrics raises serious questions about the effectiveness and reliability of ESG data and ratings. The C3 paper cites studies that are quite concerning in this regard.
Like what?
For instance, research by academics at Columbia University and the London School of Economics compared companies included in ESG fund portfolios to similar companies not included in those funds. They found that the companies in the ESG portfolios actually had worse compliance records regarding labor and environmental regulations.
Wait, hang on. Companies in ESG funds had worse environmental and labor compliance. That seems to fly directly in the face of the whole idea, doesn't it? How is that possible?
It is deeply counterintuitive, and it raises profound questions. The study suggests that perhaps inclusion in these funds isn't necessarily driving behavioral change as intended, or perhaps the metrics or data used to determine inclusion aren't effectively capturing real-world compliance or impact. It forces you to question what exactly these ESG ratings and fund inclusions represent if they aren't even reflecting basic regulatory compliance.
That's troubling. And you mentioned another study related to data reliability, about ratings providers.
Yes, the C3 paper details a study by researchers at MIT and the Frankfurt School, which uncovered some significant issues with how at least one ESG ratings provider managed its historical data. These researchers found that this provider had retroactively changed historical ESG scores in their database.
They changed past scores.
Yes, they downloaded the same data for the same companies at different points in time and discovered that the historical scores had been altered between downloads.
So they were literally changing the past performance data. Why on earth would a ratings provider do that?
Well, this study doesn't definitively state the motivation, but the effect was clear. The median overall ESG scores in the later version of the data were 18% lower than in the initial download. And the changes to the subscores were even more dramatic. The E subscore was 44% lower, S was 16% lower, and G was 7% lower in the rewritten data.
Wow.
This kind of retroactive data manipulation, regardless of the reason behind it, severely undermines trust in the historical performance and the reliability of the metrics themselves. If the data isn't stable or transparently managed, how can investors truly evaluate performance or compare companies accurately over time?
Yeah, that fundamentally erodes confidence in the very data infrastructure that supposedly underlies ESG analysis. That's a huge problem.
It's a significant challenge the industry is grappling with, definitely. Another major concern, particularly from the free enterprise perspective highlighted in the C3 paper, is the potential for economic harm and unintended negative consequences stemming from certain ESG-driven investment decisions, particularly widespread divestment or avoidance of certain sectors.
How could avoiding investments cause economic harm? What's the argument there?
The argument is that restricting the flow of capital to essential industries, even those facing a long-term transition like fossil fuels, can have immediate negative effects. The paper quotes figures like Steven Schwarzman, the CEO of Blackstone, who warned back in 2021 about the potential for social unrest due to rising energy prices caused by underinvestment. He noted the difficulty of raising capital for new production. And Jamie Dimon, CEO of JP Morgan Chase, famously stated that stopping investment in new oil and gas projects right now would be the road to hell for America, arguing for the need for continued responsible investment during the energy transition.
So the concern is that prematurely cutting off capital could lead to energy shortages, price spikes, and broader economic instability.
Yes, and potentially even worse environmental outcomes in some cases. Analysts have argued, for instance, that efforts to restrict investment in natural gas infrastructure have led some countries to rely more heavily on dirtier coal, which increases global emissions and energy costs simultaneously.
Right, the unintended consequences.
Exactly. The core concern articulated in the paper is that government actions, or even strong market pressures driven by non-pecuniary goals, could nudge or force capital away from industries based on political definitions rather than market signals, thereby, in their view, troubling the efficient functioning of the free enterprise system.
But there's even data in the source suggesting economic harm from anti-ESG actions, too, isn't there? It cuts both ways.
That's a crucial point for balance. And yes, the C3 paper does mention it. Analysis has shown that Texas's state-level anti-ESG laws, the ones prohibiting state entities from contracting with certain financial firms deemed to be boycotting fossil fuels, actually reduce competition among municipal bond underwriters in the state.
And that costs money.
Yes, this lack of competition translated directly into higher borrowing costs for Texas cities and counties. It cost Texas taxpayers an estimated $300 million to $500 million in increased interest payments over just an 8-month period.
Wow.
So this data, along with arguments like Devin Hartmey's point that forced fossil fuel divestment can harm public pension performance, shows that economic risks are definitely not limited to just one side of the political debate around ESG. Actions against ESG can also impose significant costs.
That really underscores how entangled and complex this whole thing is, and how both pro and anti-ESG stances can have negative economic consequences if not handled very carefully. And this leads directly into the intense politicization of the entire issue, doesn't it?
It's perhaps the defining feature of the current landscape, unfortunately. As the C3 paper argues, if the government steps in to define what is sustainable, or which ESG factors are paramount, it inevitably injects political biases into the metrics and the desired outcomes.
Right.
The paper points out that environmental decisions, for example, often involve complex trade-offs. Improving air quality might have implications for water usage or land use. Deciding which environmental impact is better, or prioritizing one over another, is often subjective and political, not purely scientific or economic. And trusting government agencies to define the appropriate E-investment, the argument goes, takes these preferences away from private actors and puts them squarely into the political sphere.
And this is what's creating that bifurcated policy and regulatory system the paper describes, with different states going in opposite directions.
Exactly. You have some states enacting laws promoting ESG considerations in investment decisions, sometimes even for public funds, while other states are passing laws explicitly restricting or prohibiting the use of ESG factors, particularly for pension funds, citing those fiduciary duty concerns.
What a mess for companies trying to operate nationally.
It creates a fragmented and often conflicting legal and regulatory environment for large investment firms. It significantly increases their compliance costs, their litigation risks, and makes it incredibly difficult to navigate different state requirements simultaneously. The paper argues that this political conflict ultimately harms the hardworking Americans whose retirement security depends on the efficient and clear functioning of this investment system.
So the politicization itself is creating friction and potentially negative consequences for investors.
Okay.
On top of all this, there are also concerns about honesty and transparency in the market, things like greenwashing.
Absolutely. Greenwashing is a major concern, and it's basically defined as overstating or misrepresenting ESG or sustainability credentials, whether it's for a company, a fund, or a specific investment product, usually to attract capital or enhance reputation.
Yeah.
It's a problem because it directly erodes trust in the authenticity of sustainable investing claims. Your U.S. ISI source even provides a taxonomy of greenwashing tactics drawn from the Financial Times, listing strategies like making misleading or vague claims, attention deflection, blaming consumers or other entities, attention reduction, which means limiting disclosure or hiding negative information. This is closely related to green hushing and attention timing, like diluting future targets or delaying action.
Okay, green hushing, that term isn't as widely known as greenwashing. What exactly is that again?
Green hushing is essentially the opposite side of the coin from greenwashing. So instead of overstating positive actions, green hushing is when companies or investment firms downplay or deliberately avoid talking publicly about their genuine ESG initiatives or sustainability practices.
Why hide good things?
Often they reframe them using less charged language like risk management or operational efficiency. The primary motivation, particularly in the current politically charged U.S. climate, is often to avoid the political backlash or controversy associated with the term ESG. Companies might be doing good work on climate or social issues, but they fear being labeled woke or facing political attacks if they publicize it using that terminology.
So they clam up to avoid the fight.
Pretty much. But both greenwashing and greenhushing have negative consequences. They both erode trust among investors and the public, they reduce transparency in the market, and ultimately they can slow down genuine progress towards sustainability goals. While greenwashing is facing increasing legal and regulatory scrutiny from bodies like the FTC and the SEC, greenhushing risks compliance issues in other jurisdictions, like the UK or EU, that actually require more disclosure. And it means companies might miss out on opportunities where demonstrating sustainability leadership is actually a competitive advantage. Right. The dramatic increase in media mentions cited by US IF is really telling here. Greenwashing mentions jumped from around 1,800 in the 2020-2021 period to about 5,700 in 2022-2024. Meanwhile, greenhushing mentions, starting from almost nothing, surged from just one mention to 178 over the same period.
Wow, from 1 to 178.
Yeah, it reflects a massive increase in public and media awareness and scrutiny of these transparency issues in the sustainable investing space.
Those numbers are stark. They really highlight the challenges of navigating this environment and knowing who is genuinely committed versus who is just, playing the game or trying to avoid the fight altogether. It's a tough landscape for sure. But despite all these challenges, the political opposition, the data problems, the controversies, is the field of sustainable investing still actually growing? What do your sources say about the future direction?
Yes, interestingly, both sources suggest that despite the significant headwinds, the sustainable investment market is expected to continue its growth trajectory overall. The USS report indicates that a strong majority, 73% of their survey respondents, anticipate that the overall sustainable investment market will grow over the next 1 to 2 years.
Okay, so expectations are high for overall market growth. But I noticed a nuance in the report. It seemed individual expectations were stronger than organizational plans. What's that about?
That's an important distinction the report makes, yeah. While 73% of individual respondents expressed expectations for significant or moderate growth in the broader market, only 39% of organizations expected their own sustainable investing activities to increase significantly or moderately.
So growth is expected, but maybe not driven by the current players expanding massively?
That seems to be the implication. It suggests that the anticipated growth isn't necessarily driven just by existing firms dramatically expanding their offerings, but rather by broader market dynamics. This likely includes factors like sustained and evolving demand from clients, both institutional and individual retail investors. It includes the ongoing intergenerational wealth transfer to younger demographics who tend to prioritize these issues more.
Right.
And it includes the increasing recognition across the market, despite the politics, of the material financial risks posed by issues like climate change and social inequality. The underlying drivers of demand and risk recognition seem to be still pushing the market forward, even as the political debate rages on.
So the fundamental forces driving interest in sustainable investing aren't going away. And you mentioned climate change specifically as a continued area of focus.
Absolutely. Climate change mitigation and adaptation are clearly priorities for investors in this space. Data from the GIN, the Global Impact Investing Network survey, which USME I cited, shows that a large majority of impact investors are specifically planning investments aimed at reducing greenhouse gas emissions. That was 69%. And targeting climate change adaptation and resilience, 67%. This is a thematic area with very clear impact goals.
Is there any evidence that companies are actually responding to this investor focus on climate? Are they talking about it more?
Yes, definitely. Corporate disclosures related to climate risk are increasing significantly. The USF report tracked mentions of climate change in U.S. corporate SEC filings. They found that headlines mentioning climate risk increased from about 10% back in 2018 to roughly 30% across many industries by 2024.
A threefold increase.
Yeah. Companies are clearly identifying and reporting climate change as a material financial risk much more frequently, which is a direct response to investor pressure and anticipating regulatory pressure as well.
And are investment funds themselves actually becoming less carbon intensive as a result? Is the money moving?
Well, the report includes analysis on fund-level carbon intensity that measures greenhouse gas emissions relative to the revenue of the companies in the portfolio. It shows that while progress is varied across the market, the top-performing funds, the top decile, achieved really significant reductions in carbon intensity. We're talking 60% to 80% reduction over a 3+ year period for those leaders. So this demonstrates that for fund managers who are actively focusing on decarbonization, substantial progress is indeed possible. It can be done.
Okay. What about the data and standards issues we discussed earlier? Those seem like huge hurdles. Is there progress being made on that front?
The need for more and better data and information is widely recognized as a crucial factor, maybe the crucial factor, for accelerating the adoption and effectiveness of sustainable investing.
Right.
People need reliable inputs. The evolution of policies and regulations is seen as a leading trend shaping the future by 69% of respondents in the U.S. IF survey, while the evolution of market standards is noted by 51%. Interestingly, while many investors still rely on their own custom criteria, 51% do, global frameworks like the UN Sustainable Development Goals, SDGs, are also popular for guiding investments. 42% use those.
So a mix of custom and standard approaches.
Yes. And there's a strong sentiment expressed that increased regulation requiring corporate disclosure despite the political opposition is necessary to provide the clearer, more comparable data needed for the field to truly mature and for greenwashing to be tackled effectively.
Makes sense. What about technology? AI seems to be impacting everything these days. Is it playing a role in sustainable investing?
It is, increasingly so. The USF report notes that AI and advanced data analytics are rapidly reshaping how sustainable investing is approached. AI offers powerful capabilities for things like predictive analytics to identify emerging ESG risks before they blow up, for optimizing portfolio construction based on complex ESG and financial criteria, and potentially for enhancing the measurement and reporting of actual impact, which, as we discussed, is often tricky. The GII survey found that 53% of impact investors specifically plan to incorporate AI into their processes.
Okay, that sounds promising for bringing more rigor and efficiency to the analysis, but AI itself has its own significant environmental and social footprint, doesn't it? That seems like a conflict.
It absolutely does, and the report highlights this as a crucial consideration, a real tension. AI requires enormous amounts of energy and water, particularly for training these large language models and powering the data centers they run in.
Right.
Estimates cited in the report suggest that energy demand just for generative AI could grow by 70% annually through 2027 and potentially account for around 25% of all data center energy consumption globally.
Wow, a quarter of all data center energy just for AI. So the very technology meant to help us invest sustainably has a major environmental cost itself.
That's the complex reality, yeah. While the high energy demand might spur further investment in renewable energy sources to power these data centers, which could be a silver lining, it also raises critical questions about the scale and equitable use of resources globally. Is this the best use of that clean energy?
And a social side.
On the social side, AI development and deployment raise significant concerns about potential job displacement, data privacy breaches, algorithmic bias leading to discrimination, and just general ethical governance. Investors are increasingly recognizing that they need to consider these AI-specific ESG factors. They're looking for companies to have robust policies and governance structures in place to mitigate these risks.
Okay.
And the regulatory landscape for AI is also evolving rapidly worldwide with initiatives like the EU AI Act and U.S. Executive Order, which will further shape how these AI-related risks are assessed and addressed by companies and investors.
So AI adds another layer of complexity to ESG analysis, another thing to consider, but it also offers powerful tools to potentially navigate that complexity better.
It does. It's a double-edged sword. Overall, though, the trajectory described in your sources is one of increasing precision and thematic diversity in sustainable investing. It seems to be moving beyond broad goals like simply decarbonizing a portfolio towards focusing investment capital on specific solutions, things like clean energy infrastructure, nature restoration projects, affordable housing, sustainable agriculture, and so on. Both the strategies being used and the methods for measuring outcomes are expected to continue improving as data gets better and the market matures, despite, all the significant challenges we've discussed.
Okay, this has been a truly comprehensive deep dive. Really appreciate you unpacking all that. We've traveled from the historical roots of values-based investing in, religious communities centuries ago, through the different strategies investors are using today, from principle-driven exclusions and risk-focused ESG integration to solution-oriented thematic investing and direct community impact. We've also squarely faced the difficult challenges and controversies shaping the field, the definition problems, the data reliability issues, the economic critiques, the intense politicization, and those issues of greenwashing and its opposite, green hushing.
Yeah. A lot of headwinds.
But we've also seen the signs of continued evolution and growth driven by persistent demand, increasing focus on key areas like climate change, and the potential for better data and technology, even amidst this political storm.
Absolutely. And I think for you, as a conscious capitalist trying to make sense of all this, the key takeaway from your sources is pretty clear. The world of values-aligned investing is neither simple nor static. Not by a long shot.
Yeah.
It's a dynamic, complex space, wrestling with fundamental questions about the purpose of capital, the relationship between financial performance and societal outcomes, and the influence of politics on the market. Understanding the nuances between different approaches, recognizing that ethical investing is often about avoiding harm based on principle, while impact investing is about proactively creating measurable positive outcomes, and ESG integration is about analyzing financial materiality, is absolutely crucial. You have to know what you're actually trying to achieve.
Right. And being aware of the pitfalls, the potential for greenwashing, the data challenges, the economic arguments against certain approaches, and the reality of political opposition is essential for making informed and effective choices in this space. You can't ignore the problems.
Absolutely. It requires looking beyond the labels and the headlines. It demands diligence in asking specific questions about the strategies being employed by a fund or an advisor, the motivations driving them, the transparency of the data they're using, and crucially, seeking credible evidence of verifiable outcomes or genuine impact, rather than just accepting claims at face value.
It's really about applying that conscious capitalist mindset, not just to whether to invest with values, but how to do it effectively and authentically in what is clearly a very challenging environment.
Precisely. It requires engagement and a critical, discerning approach, not just taking things off the shelf.
Okay, so here's a final thought for you, the listener, to carry forward and maybe mull over. In a world where finance is increasingly intertwined with deeply held values and pressing societal challenges, how can you, as a conscious capitalist, ensure your investments not only genuinely reflect your principles, but also contribute meaningfully to the future you envision, while skillfully navigating the powerful, conflicting forces and inherent complexities that define this space today? It's a question that really gets to the heart of what conscious capitalism means in action, I think.
It certainly is, and it's one that requires ongoing consideration and learning as this landscape inevitably continues to evolve.